Good evening, students. Welcome to the session. Have you revised Chapter 6A Deduction, students? Yes. Yes, good evening, everyone. So, Chapter 6A Deduction, not very complex topic, but I hope you have revised. As I told you, it can come for the computation of total income questions. You may have like small bit of this Chapter 6A portion. And as far as today's topic that we are going to deal with, that is going to come as an independent question or as a part of the case law. Very good, Viraj. Good evening. Good evening, Sailesh. Very good. Okay. So let's get started with the Chapter 6A deductions. So in the last class, what we have done is I'm not spending much time on revising the chapter because those are very simple, self-explanatory topics that we have already discussed so far. So we have done till now 80C to 80U other than the Chapter 6A deductions pertaining to the income category. So till now what we have done was basically, I'll just quickly open up the chart that we have last time made. So till now we have done the investment based, expenditure based. So investment based ATC, ATCCC for the pension scheme, ATCCD for the NPS, employer contribution, employee contribution, and when you contribute to NPS, and the expense base, which is medical premium ATD, then for the disabled maintenance ATDD, and then ATDDB, which is that it should be ATDD and not ATDDD. 1 second, I'll just quickly make a correction over here. So this should be ATDD, yeah. Then you have the ATU, which is again for the disabled person himself. And then you have the interest-based deduction under ATEE, AA, and EEB, which is for the education, for the housing, then for the electric vehicle, all of that. Then the here you should also write the ATE as well. Okay. Then the contribution base, which is under ATG, ATGGA for the political parties, and then ATGGC for the scientific research, and rent payments for ATGG. So all of that we have done. Now today we are going to move towards the income-based deductions. Now what are income-based deductions? So students, if you recollect, you have already done some bit of the income-based deduction under PGBP. Which one was that, student? That we have already done the income-based deduction under under the PGBP chapter. So which one was that? Do you recollect? Yes, students? Let me see who is able to recollect the income-based deduction that we have dealt with under the head PGBP. Yes. Which one were those under PGBP that you have already done it? Yes. All of you very quickly. So under PGBP, you used to get certain sectorial specific deductions. So which one were those? Let me see who is able to recollect. Yes, students. So those were for the 35 AD. If you remember, for the specific sector with respect to the income that you used to earn from the capital expenditure that you used to make, right? Against that income, that entire capex was allowed as the deduction under section 35 AD. Are you able to recollect that? So 35 AD is the deduction which is given for the capital expenditure, right? Which is given for the capital expenditure. So, if you recollect, under 35 AD, what was the amount of deduction under 35 AD? How you used to compute the 35 AD deduction? Yes, Mohammed, very good. So how do we use to compute the 35 AD, students? Are you able to recollect that? Yes, how we used to compute the 35 AD deduction, students, very quickly. We have done that in a greater detail already, right? So under 35 AD, the capital expenditure which was there, even the one which was capitalized in the books of accounts, even the one which was capitalized in the books of accounts, as on the date of the commencement of the business, that was allowed as the deduction under section 35 AD. And there were list of businesses for which the deduction was allowed under 35 AD. Are you able to recollect? Yes or no? So similarly, for the specific sectors, we have the deduction under the AT, IA, IB and all of these sections, which is under chapter 6A. Under chapter 6A, we have the deduction under ATIA, ATIB and all of other ATI sections which are there. That is what we are going to look into. Good evening, Vanshika. So basically, what is then the difference between section 35 AD and these particular sections? So if you remember, under 35 AD, as I said, in the sector-specific deductions, the deduction was allowed with respect to the expenditure incurred for the specified business. The deduction was required to be allowed against the specified expenditure that has been incurred. That is what was allowed under 35 AD. Right? So under 35 AD, it was the investment-based deduction. 100% of the capex which is wholly and exclusively incurred for the specified business was allowed as the deduction. Right? Whereas under ATIA, ATIB, the expenditure is not allowed, students. The income itself is allowed as the deduction. The income itself is allowed as the deduction. Are you getting that point? Under the PGBP, under 35 AD, you are allowed the expense as a deduction. Whereas, under the ATIA, ATIB, you are allowed the income as the deduction. So that is the difference between the two. Fine. Now, what are the income-based deductions that we are going to cover over here? Let's write down. Section ATIA, ATIB, Section ATIAC, Section ATIAC, fine. Then Section Section 80 LA, Section 80 LA, then Section 80 IE, Section 80 IE. Here you can only write Section 80 IE. Section 80 IAB, Section 80 IAB, so 80 IA, 80 IB, 80 AIB, and then 80 AIC, Section 80 IBA, and finally 80 QQB and 80 RRB. Section 80 QQB and Section 80 RR. And then Section 80M, Section 80M, Section 80M, and then 80TTA and 80TTB. Okay, 80TTA and 80TTB, and finally Section 80P and Section 80E. Yes. So this is what we are going to cover. Yes, students, is it clear? Yes, good evening, Geeta. So let's start with first, okay, and then one more, of course, which is not part of chapter 60 deduction, but section 10EE. Fine. So let's start with it. Right now, section 80 IA, then make the different columns basically. Section 80 IA, then section 80 IAB, section 80 IAB, then section 80 IB, section 80 IB, and then finally section 80 IBA. Okay, so just 4 columns we need to make over here. 80 IA, 80 IB, 80 IBA, and 80 IAB. And of course, then you can also make 80 IE. Fine. Now the first point, who is the eligible assessee for all of these sections? First, we are looking at 80 IA. So, who is the eligible assessee? Now, in respect of section 80 IA, the eligible assessee or the eligible business, as we may call, let's write down eligible business rather than assessee. So, eligible business is developing or operating and maintaining any infra facility. So developing, operating and maintaining, or developing or operating and maintaining any infra facility. That is number 1. Second one, industrial parks. Industrial parks. And third is the power generating unit. Power generating and distribution or transmission or distribution unit. Fine. So these are the eligible undertakings which are there, which are basically, or eligible businesses which are there, which are covered for the purposes of the 80 IA. Which one did I say? Developing or operating the infrastructure projects. Then secondly is the power generating unit, power undertakings, and the industrial parks. Now understand one thing, these deductions are no more now available to the new businesses because after 2017, the businesses which are incorporated or going under such sectors, they cannot claim this deduction. It is only for the existing businesses which have been incorporated before 2017, this deduction is applicable to them. So this was given at the time when these sectors were, in the development phase. In order to promote these sectors, this deduction was granted to them. Now, basically, this deduction is now no more available to the new businesses. It is already being claimed by the existing businesses. Are we getting that? So because after 2017, if any business is incorporated, they are not eligible for that. It is only before 2017 that the businesses were there, which were into the development or maintaining of the infra facility or the industrial parks or the power generating units or transmission units, they were eligible to claim. So these are the specific businesses for which this deduction is applicable under 80IA. Now understand one particular point over here. When I say about the industrial undertaking which are there or the infra projects which are there, the question which arises is that under the infra projects, the question that always arises, what is the infra project which we are talking about? What are the infra projects that we are talking about? So in one of the case, the question was, let's say for example, there are inland container depot. Does anybody know what are inland container depot? Yes, anyone knows about what are inland container depot? Yes, students. Anybody knows what are ICDs, inland container depot? Customs law, you would have studied something. Yes. What are inland container depot? Because the question before the Supreme Court was whether inland container depot are to be considered as infrastructure facility. So that, if they fall under the infrastructure facility, only then they will be eligible for 80IA deduction. Yes, Mohammed, very good. These are the ports. These are basically the areas in the ports which are used to transport the goods or for the storage of the goods. So inland container depots which are there, they are basically located at a distance from the seaport and they basically enable or act as a facilitator to store the goods there until the clearance is made because there are certain perishable goods sometimes, so then they just allow that facility to store the goods there at the ports until the clearance is made. So they are basically there to promote the export and import, okay, in the country by being a facilitator, by allowing or enabling the exporters and importers to um, keep the products, okay, there. So the question which arises is that whether in that case, can they be considered as the infrastructure facility? So the Supreme Court in Container Corporation of India Limited case held that yes, these are the infrastructure facility. These are the infrastructure facility and therefore they would be eligible for deduction under section 80IA. Okay, they would be eligible for deduction under 80I. Okay, so just write down. So just write down. Inland container depot are also considered or can also be considered as infra facility, can also be considered as infra facility, and therefore eligible for action. Are we clear about this? Now, understand one more important point. Another question that arises in case of these particular projects is, so ATIA requires that the assessee must be carrying on the business of developing, maintaining and operating, or developing, maintaining and operating an infrastructure facility, which should be owned by a company registered in India. So it requires that this particular business should be owned by a company registered in India. And at the same time, the enterprise should have entered into an agreement with the central government. The enterprise should have entered into an agreement with the central government or the state government or any other statutory body which is there for developing, operating and maintaining the infrastructure facility. Now, the question which arises is, let's say for example, the assessee has entered into an agreement. Let's say the agreement has been entered into with the state government by a partnership firm. And later on, the firm is converted into a company. Can one then say that ATIA can be now claimed by the company? So basically, ATIA requires that the business should be of maintaining, operating the infrastructure facility. It says the business should be owned by a company which is registered in India. And the company should have entered into, and it says that the enterprise should have entered into an agreement with the central government or state government or any local authority. So the question which arises is, can one say that the firm has entered into an agreement with the central government or state government and then the firm is converted into a company? So therefore, the company can claim the benefit of ATIA. What do you think? Yes, what do you think? Whether the company can claim? Yes, students, what do you think? Can they claim? So in this particular case, the Supreme Court, in a very recent decision, said it looked into the memorandum of association of the company, wherein it observed that the main objective of the company was to acquire the firm as a going concern and continue the business carried on by the firm. So it looked into the memorandum of association of the company and it observed that the main object of the company was to acquire the business of the firm as a going concern and to continue the business carried on by the firm. The effect of which would be what? All the properties of the firm would now vest with the company. And now the firm will be succeeded by the company. And therefore, the Supreme Court held that the company is qualified for deduction under ICAI, even though the agreement was executed by the firm with the state government. Because the company succeeded the firm. Okay. So this case law could be asked as a kind of a case law per se. But as a standalone question, I did not see it. But as a case law, this is mentioned in your module also. Okay. Mohammed, are we clear? Yes. Okay. So now let's proceed further. Now under ICAI, these are the businesses which are covered. Now for what is the deduction that is allowed under it? Let us look into that. So we know that these are the businesses which are covered under ICAI. So the profits and gains from these businesses which are there, the profits and gains from these businesses will be allowed as the deduction. So 100% of the profit. So quantum of deduction you can write down. Will be 100% of profit derived from the eligible business. So 100% of the profit which is derived from the eligible business is allowed as a deduction under section 80IA. Now one more question that arises is, for how long the profits can be claimed as the deduction? So we understand first of all that the deduction is given to the infrastructure facility. You can write here also owned by the company, plus you can write here agreement with the government. There should be agreement with the government. Are we clear? So in that particular case, what will be the period of the deduction which will be allowed? So the period of deduction that is allowed under ICAI is, the assessee has the option to claim the deduction for 10 consecutive assessment years out of the 15 assessment years beginning from the year in which the undertaking develops or begins to operate the infrastructure facility, or develops the industrial park, or generates the power, or commences the transmission or distribution of power. So write down eligible period, ten out of 15 AYs. 10 out of 15 AYs. This is the eligible period under ICAI. However, for an infrastructure facility like road, highway project, it is 10 out of 20 years from the year in which the enterprise develops or begins to operate the eligible business. For roads or highway projects, for the roads or the highway projects, or water supply project or housing projects, not the housing, sorry, water supply projects, it will be 10 out of 20 years. Fine. So what are the businesses which are covered under ATIA? We have infrastructure facility, fine. And what did I say? In the case of the infrastructure facility, it should be owned by a company and there should be agreement with the government. And let's say, for example, if the business is transferred, then the transferee can also claim it provided it is transferred as a going concern. ICDs are also included as the infrastructure project. Are we clear? Then industrial parks. Development of the industrial parks. And finally, the power undertaking for the generation or distribution or transmission or distribution of the power generated. Even it includes the renovation and modernization of the transmission or distribution lines. Then 100% of the profits from the eligible business are available as deduction for 10 out of 15 previous years or the 10 out of the 20 previous years. Assessment years. Okay. Now, what are the conditions over here? The condition over here is that the books of accounts are required to be audited by a CA and it has to be furnished as per the due date under 44AB, plus the return of income should be filed under 139(1). Third condition is that the profits which are there, that profits are only eligible for the ATIA deduction. Okay, so the deduction will be to the extent of the eligible business profits. So just write down return of income under section 139(1) plus the audit under section 4. Okay, audit before the due date, not under 44AD, audit before the due date under section 1, under section 44A. Okay. Are we clear? Yes or no? Now, this deduction will be available to the amalgamated or resulting company as well. The deduction will be available to the amalgamated or resulting company also. In case the amalgamation happens, then the deduction will be available to the amalgamated or resulting. So you can write it over here. Deduction available to amalgamated or the resulting company or the balance period. Okay? Yes or no? Any questions? Any doubt? Yes? Perfect. So that is about ATIA. That is about the ATIA. Now, in respect of ATIAB, next is the ATIAB. So this we discussed about the ATIA. So under ATIAB, what is the deduction on? What is the eligible business? The undertaking or enterprise engaged in the development of SEZ. So this is available to the developer of SEZ. So the business, eligible business over here is development of SEZ. Again, this is available only to the businesses which have commenced the business before the 2017. So after 2017, this deduction is no more available. So this is available to the developer. Again here, 100% of the profits are eligible. So just write down 100% of profit derived from the eligible business. Then in this particular case, what is the period? So it is 10 out of 15 assessment years. It is 10 out of 15 assessment years. Here also it is 10 out of 15 assessment years. Fine. So that is section 80IA-B. Okay, that is section 80IA-B. So 80IA we have done. Now we are doing 80IA-B, which is the development of the SEZ. Development of the SEZ. Okay. Now, third one is, okay, one more thing over here. The deduction is also available in case where the developer who develops the SEZ transfers the operation and maintenance of SEZ to another developer. Then the another developer, if it takes it as a going concerns business, if it's a succeeding the business, then the deduction will be available for the balance period to the another developer. So you can write it over here. Here also you can write amalgamated or resulting company for the balance period or the successor. Deduction available to successor. Okay, for the balance period. Now, one question which arises in the context of ATIAB is, let's say for example, there is an assessee who is engaged in developing the space in the SEZ. Now he develops the space and lets out that developed space along with other amenities. Let's say he has an SEZ, he develops that spaces in the SEZ and then lets out the spaces in the SEZ along with the other amenities. My question to you is whether that would be PGBP or whether that would be the IFHP. Thank you so much, Shinoy. I'm glad your paper went well for November 23. Yes, good evening, Namrata. Yes, PGBP or IFHP, the income from leasing out of the developed spaces along with the other amenities in the SEZ. Yes, Biraj, PGBP, Mohammed says PGBP, anybody says IFHP? Yes, students, IFHP, PGBP faster. Yes, Namrata, I will upload it. Yes, yes, fast. PGBP, IFHP. PGBP, Yamini. Okay. Yes, all of you are correct. Yes, Sandhya, very good. It's PGBP. So basically, if you understand this, there was another case on the similar point. Who remembers the case? We had done that while we were started with the PGBP chapter. Case name, very famous case. Who remembers the case name? Yes. Who remembers the case name, students? There was one case on this was PGBP versus IFHP. Let me see who recollects. Yes, Viraj, Raj Dadarkar, but there was a very famous case more than that. Very good. You remember Raj Dadarkar? Another case also, Raj Dadarkar was on the point of where the partnership firm claimed the income under PGBP and it was disallowed. There was one more case. It was on the name of the city in India. Yes, one more clue I have given to you. Let me see. A city in India in the south. Another clue. Now you should be able to remember. Enough clues. Yes. Yes, Sandhya. Very good. Chennai Properties. Yes. Raila Corporation and Chennai Property case. Yes. So Chennai property case was on this point, whether the income is under PGBP or IFHP, you need to look into the memorandum of association of the company. Yes, very good, Usha. Chennai properties and investment case, right? So similar point would be over here. So there have been series of cases where it has been clearly held by the high courts that the scheme of development of the industrial parks wherein the assessee is leasing out the spaces that would be chargeable under the PGBP and not under IFHP. And the CBDT has now clarified this particular point as well. So just write down. So just write down over here. Income from leasing of developed spaces along with amenities, PGBP and not IFHP in the SEZ CBDT circular. So there's a CBDT circular on this particular point. Fine. So that is ATIAB. What is ATIB? The ATIB which is there, again that is for the eligible businesses. Under ATIB, the eligible businesses, the business of processing, preservation of and packaging of fruits or vegetables. So under ATIB, I'm not talking about ATIAB, ATIB. ATIB is about processing, preservation and packaging of fruits, veggies, meat, poultry, dairy or marine products. Right? Or the business of handling, storage and transportation of food grains. Handling or transportation of the food grains. Are we clear? Again here, the 100% of the PGBP for the first 5 years and then 25% for the remaining 5 years is available because the total deduction is available for the 10 consecutive years beginning with the initial assessment year. Under ATIA, ATIAB, you could choose the years from the 15 assessment years which are there. Any 10 years you can choose. But those have to be consecutive. It should not be like 1 year I'm claiming, next year I'm not claiming, then again I'm claiming, again I'm not claiming. Not like that. But out of the 15 years from the commencement, you have to choose the 10 consecutive years in 80IA, 80IAB. Whereas in the 80IB, you don't have the option to choose. You have to claim from the initial years up to 10 years. So for the first 5 years, 100%. For the balance 5 years, 25%. In case of others, in case of company SSE, 30%. So just write down 100% of profit from the eligible business for first 5 years, then 25%, 30% for company for next 5 years. This is for the 10 EYs from the commencement. Okay, this is for the 10 EYs from the commencement. This particular deduction is given. This is under section 80IB. Fine. Next one is 80IBA. Now, 80IBA is basically for the housing sector, which is for the business of developing and building the housing projects. So, developing and building housing projects. So this is available only to the housing sector. Now again, this is available to the projects approved between 2016 and 31st March 2022. So projects approved between 1st June 16 to 31st March 22. The project is completed within the period of 5 years from the date of approval by the competent authority. So, project to be completed within 5 years from the date of approval. And the carpet area of the shops or commercial establishments in the housing project should not exceed 3% of the total carpet area. So just write down the carpet area, because this is for the housing project. So, you know, it's like very common in the housing project. There are some shops which are established down so that people have the ease to live in that property. So the carpet area of the commercial units should be less than 3% of the aggregate carpet areas. These are some additional conditions in the project. And then there are certain few more conditions with respect to that the residential unit is allotted only to one individual, and it should not be allotted, any other unit should not be allotted to same individual or his family. Then the size on the plot of land in which the project is situated should not be less than 1,000 square meters. The carpet area of the residential unit should not be more than 30 square meter. Then percentage of floor area to be utilized by the project should not be less than 90% of the floor area. There are many other conditions which are also given in your module as well. So which I'm just, putting it across over here for your convenience. So you can maybe just copy it down, because these conditions not necessary to remember, but just for your convenience, I'm putting it across. So see, these are some of the conditions which are there. where a residential unit in the housing project is allotted to an individual, no other residential unit in the housing project should be allotted to the individual or the spouse. Then there are these conditions with respect to the metro cities, non-metro cities, as to the size of the plot on which the project is situated, carpet area of the residential unit, and the percentage of floor area ratio to be utilized by the assessee. And in case the project is approved after the 31st of after the 1st of September, if the project is approved after the 1st of September, then there are additional conditions. And what is the additional condition? Then there are the new conditions with respect to the floor area and all of that, which is also I'm putting it across over here. So need not remember, but just know that these are the conditions which are there. So this is the same condition that the one unit should be allotted to one person only and not more than that. Then with respect to the location of the housing project for the metro cities, the size should be not less than 1000 square meter. That is same. The carpet area is 60 square meter if the project is approved after 1st September, and if it is before 1st September, it is 30 square meter. For any other place, it is 90. In the before September, it is 60. Then the floor area ratio is almost the same, 90 and 80. Okay. So these are certain additional conditions which are given. Clear? And in case the project is not completed within the 5 years, then the deduction which has been claimed shall be deemed to be the income. Okay. So just write down over here. Project to be completed within 5 years. If not completed, deduction will be deemed income. Deduction shall be the deemed income. Fine. And in this case, again, your 100% of the profits will be allowed as the deduction. The 100% of the profits will be allowed as the deduction. Okay, one more condition you need to write it. If the project is approved after 1st September, stamp duty value of each residential unit less than rupees 45 lakh. Stamp duty value should be less than rupees 45. So in this particular case, the 100% of the profits will be allowed as the deduction. Hundred percent of the profits will be allowed as the deduction in respect of 80 IBA. Are we clear? Yes or no? So for 80 IBA, 100% is allowed. Here there is no condition in terms of the eligible years. There is no condition for the eligible years. So this is not applicable. You can claim it at any time once the project has started. Okay. So that is section 80 IBA. Any questions so far, students? No? Okay. Last one, 80 IE. Section 80 IE. Now, section 80 IE, which is there, is in respect of undertaking in the northeastern states. So, in the year, the eligible businesses, the undertakings in the northeastern state. Northeastern states, which are engaged in manufacture or production of any article. So, if they are engaged in the manufacture or production of any article or in the business of hotel, hospitals, running the institutions for the hotel, civil aviation related, IT centers, information technology, biotechnology, these will be eligible. So, undertaking in northeastern states in the manufacturing or production, eligible business. Engaged in the eligible business. Now, what is the eligible business over here? So, the eligible business over here is I've written it down over here, hotel, adventure and leisure sports, medical and health services, old age home, vocational training, running information technology, biotechnology, all of it. Now, what is the quantum of deduction? 100% of the profit. And again, this shall be eligible for the 10 assessment years from the initial assessment years. Okay. So, here you can claim 100% of the profits for the 10 assessment years from the commencement. Fine. Yes or no? That is section ICAI. Now the last one, which is very, very important, under ICAI series, is ICAI. That is ICAI. Let's write down over here. Section ICAI. Now this is the deduction given to these startups. This is a deduction which is given to these startups. So just write down ICAI deduction which is given to the startups. The startups, what is the meaning of the startup? Who is the eligible startup? So a company or the LLP incorporated between 1/4/16 to 31st March 24. Turnover less than equal to rupees 100 crores and registered with DTL IT. Engaged in innovation or development or the improvement of the products. Improvement of the products or the services. Then, or a scalable business model with high employment generation potential. Employment generation or wealth creation potential. So this is ICAI which is available only to the startups. And what is the deduction which is available in this case? Again, you get 100% of the profits. You get 100% of the profit allowed as the deduction. Now, 100% of profits, when I talk about the 100% of the profit, here, what is the period which is given over here? So what is the eligible period for which this particular deduction will be available under AT-IAC? So it says that the AT-IAC can be claimed for 3 consecutive years out of the 10 years beginning from the year in which the company is incorporated or the LLP is incorporated. So just write down over here. Write down over here. 100% of the profits. Here also you have the 100% of the profits, and for the 3 consecutive assessment years. 3 AYs out of the 10 AYs. Out of the 10 AYs. Yes. Then there are certain additional conditions over here. What is the additional condition over here? Yes. So the additional condition over here are that the business should not be formed by the splitting up or the reconstruction. The business should not be formed by the splitting up or the reconstruction. What do I mean by the splitting up or reconstruction? They say that the business has to be a new business, basically. It should not be formed by the splitting up or reconstruction of the existing business. So the business should not be formed by the splitting up or reconstruction of the business. Secondly, it should not be formed by a transfer of the old plant and machinery. Old plant and machinery. Exception, again the same exception as we always have for the plant and machinery. Imported second-hand plant and machinery allowed. And if the old plant and machinery is less than 20% of the total value of the plant and machinery. So just write down over here. Additional conditions. Business should not be formed by splitting up or reconstruction. Secondly, not formed with transfer of old plant and machinery. The exception to that is imported second-hand plant and machinery, value of second-hand plant and machinery less than 20% of the less than equal to 20% of the total value of plant and machinery. Fine. So that is AT-IAC. Fine. Yes, students. Now I'm just giving you a quick summary in respect of these startups. Just add a new page here and just write down startup related provisions. So just this is a summary for your understanding purpose, so that in case a question is asked in the examination for startup, you can recollect all of that. And you are going to give me all the answers for that. Under salaries, under the head salary, is there any provision for the startups? No, Yamini. If a firm is converted into company, AT-IAC will not be applicable. Yes, under the salaries, is there any provision which is only applicable to a startup? under 14 to 17, under section, under the head salaries. See if you can recollect, there's a one small provision which is only applicable to the startups. Let me see who is able to recollect. Yes. There is one small provision which is there under the salaries. Yes, yes, yes. We have done that as well. Let me see who recollects. Yes, students, faster. There's one small provision with regard to the perquisite taxability. We have done that while we were doing the capital gain chapter, students. Yes, I've already given you the hint. Do you remember? Yes, students, think about it. Go back to your capital gain class and look at your notebooks. One small provision, which is only with respect to the startups. Yes, 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 yes. No, nobody remembers? Okay. It was with regard to the ESOPs taxability, the TDS on the ESOPs. So if you remember, the ESOPs, when they are exercised, in the year of exercise, they are treated as the perquisite, isn't it? However, for the purposes of the TDS, for the purposes of the TDS, the eligible startup who is required to deduct the TDS on the ESOPs, the taxability, the TDS will be deducted within 14 days from the expiry of the 48 months from the end of the relevant assessment year, or from the date of the sale of the ESOPs, or from the date of assessee ceasing to be the employee of the startup, whichever is the earliest. Do you recollect? We have done that in the capital gain class. I'm just opening up that screen. So when ESOPs are exercised, so if the ESOPs are allotted by the starter, the perquisite taxable on, or you can write it over here, TDS on the perquisite deductible on 1 second. I think fine. On the earliest of these events. Just write down over here for the starter, salaries for ESOPs granted to the employees perquisite on the exercise. However, TDS under section 192 on 14 days from earlier of expiry of 48 months, expiry of the 48 months from the end of the assessment year, the sale of ESOPs or ceasing to be employed. Date of whichever is the earlier. So the taxability under the TDS under section 19 will be on this basis, isn't it? So that is under the head salaries. That is under the head salaries, where the ESOPs are granted, isn't it? Okay. Now, under the head PGBP, was there any startup related benefit that you could recollect? Any startup related benefit that you can recollect under the head PGBP? Yes or no? Because see, this is very important to remember. If a question is asked, it would be the entire question that would be tested. So remember that particular point, students. Okay. Yes. So the TDS and the income tax on the perquisite. This should be yes. Payable on 14 days from. This should be 14 days from. Under capital gain as well. Yeah. Then under the PGBP, is there any provision? Is there any provision under PGBP? Answer is no. Under capital gain, there is one more provision. Under the capital gains, there is a specific section, which is section 54 GB, exemption under 54 GB, which says what? Where the capital gain arises from. So the the asset to be transferred should be the long-term capital asset being the residential property. Including the plot of land. Which is owned by the eligible assessee. Owned by individual or the HUF. So here eligible assessee, or you can write down like this. Eligible assessee will be individual or the HUF. Individual or the HUF. It doesn't say resident or non-resident, it can be both. So the capital gain should be from the long-term capital asset being a residential house property, which could be even the plot of land. And what is the eligible asset to be purchased? The eligible asset to be purchased is subscription of the equity shares of the eligible company. So, the assessee should utilize net sale consideration, for subscription of equity shares, subscription of the equity shares of which company? Of the eligible company. Of the eligible company. Of the eligible company. Now, what is an eligible company over here? What is the eligible company over here? Now, the eligible company which is referred over here is, the eligible company referred over here is which fulfills the following conditions. So, eligible company means incorporated, it should be incorporated in India. It should be incorporated in India during the period at any point of time from 1st April of the previous year, relevant to the assessment year in which the capital gain arises, to the date of furnishing the return of income by the assessee under 139(1). So, incorporated in India during the previous year, in which capital gain arises, to the due date of furnishing ROI under section 139(1). Fine. Engaged in, it should be engaged in business of manufacturing. Engaged in business of manufacturing. It should be engaged in the business of manufacturing. Or in the eligible business. Or it should be in the eligible business. Or the eligible business. Now, what is the eligible business over here? Eligible business here means the same business that I was talking about under 80 IAC, which is innovation, which is the business of either the innovation or the development or improvement in the products or processes or a scalable business model which has the potential for employment generation or wealth creation. Generation or wealth creation. Fine. So that is the eligible business. Third point. So it should be incorporated during the period from in which the capital gain arises till the time the return of income is filed. Secondly, it should be either in the manufacturing or in the eligible business, which is referred under 80 IAC. It is a company in which the assessee has more than 25% of the share capital or voting rights. ASSI has greater than 25% of the share capital or the voting rights. Finally, it should be either MSME, it should be the MSME or qualifies to be MSME or the eligible startup or the eligible startup as referred to in section 80 IAC. Fine, it should be the eligible startup as referred to in 80 IAC. Yes, are we clear? Are we clear? So, the amount should be invested by the ASSI in the subscription of the equity shares of eligible company. What is the eligible company? The eligible company means what? The company which is incorporated in the year in which the capital gain arises till the time the return of income is filed by the SEC. Under 139(1). So it is to be within the due date. It should be in the manufacturing or in the eligible business. It should be a startup or MSME. And the SEC should have more than 25% of the share capital. Are we clear? And what is the time limit for investment in the shares of the company? 1 year. Sorry, what is the time limit for investment? The time limit for investment is before the due date of filing return of income. So before the due date of ROI under section 139(1). Then what will be the exemption? What shall be the exemption under section 54 GB? The exemption under 54 GB will be the entire amount of the capital gain. The capital gain which is there into the capital gain into the cost of the new asset, divided by the net sale consideration. The way we do it under the 54 GB. Okay, the way we do it under the 54 GB. Now, what is the new asset? That is what we are going to talk about. What is the new asset? So it says the company has to, within the 1 year from the subscription, purchase new asset. So the assessee who is transferring the residential property before the due date of the ROI under 139(1) has to subscribe to the equity shares. The company has to invest that amount in the purchase of the new asset within 1 year from the date of subscription. So you can write down time limit for the company to invest by the assessee. 1 year from the date of subscription in the equity shares, the company should purchase new asset. Now, what is a new asset? Let's try and understand. So what is a new asset which is considered over here? So the new asset here means plant and machinery. New asset means the plant and machinery. You can write it over here like this instead. New plant and machinery. Now this will exclude second-hand plant and machinery, even if it is imported. Even if imported. Here, imported second-hand plant and machinery does not qualify. Unlike under 35 AD and other sections where for the additional depreciation you can claim the additional depreciation or 35 AD deduction on the imported plant and machinery or under ICAI, here you cannot do that. Here, second plant and machinery used in office premises or residential accommodation and third office appliances including computers and computer softwares. Here you can write it in the bracket. For a technology-driven startup, computers and softwares can be considered as plant and machinery. New plant and machinery. For the technology-driven startups, the computers can be considered as new plant and machinery. Fine. Any vehicle and plant and machinery allowed as deduction under any section. For example, 35 AD, section 35 scientific research, those will not be included. So basically, if you are selling the house, which is a long-term capital asset or a plot of land, you can invest in these equity shares of the MSME or startup company which is there before the due date of filing the return of income. The company should be incorporated during that period when the capital gain arises till the time the return of income is filed. And secondly, it should be in the manufacturing or innovative business model, and it should be a startup which is recognized under ATIAC or their micro, small, medium enterprise. You have to invest more than 25% of share capital or voting power. The company has to invest in the new plant and machinery within 1 year from the date of subscription. Then the capital gain which will be exempted will be capital gain into the cost of new asset divided by the net sale consideration. If the company is unable to utilize for the purchase of new asset before furnishing the return of income under 139, then it can deposit the amount into the capital gain account scheme. Are we clear? So that will be then allowed as the deduction. So the way we deposit until we utilize it, you can deposit in the capital gain amount scheme. However, if the amount deposited is not utilized within 1 year from the date of subscription, then the capital gain which is there from the transfer of residential house property, which is exempted under 54 GB, that amount, that capital gain minus the amount that would not have been so charged had the amount utilized for the purchase of the new asset shall be charged to tax as the capital gain. Shall be charged to tax as the capital. So just write down here, if company is unable to purchase new plant and machinery before the due date of return of income under section 139(1), deposit in capital gain account scheme. It can deposit in the capital gain account scheme. Fine. If the company is not able to utilize if the company is not able to utilize the amount, if the company is not able to utilize the amount within 1 year from the date of subscription, within 1 year from the date of the subscription, if the amount so deposited is not utilized for the purchase of the new asset, for purchase of new plant and machinery within 1 year from the date of the subscription, then the capital gain exempted on transfer of residential house property under section 54 GB, right? The capital gain exempted on the transfer of the residential house property under 54 GB minus the amount of minus the amount that would not have been charged, the amount that would not have been charged had the amount utilized for the purchase of the new asset. Not charged, amount that would not have been charged if utilized for purchase of the new plant and machinery shall be charged to the capital gain. So capital gain will be equal to this. Okay. As the income of the previous year in which the 1 year expires. Income of the previous year in which 1 year from the date of subscription expires. Okay. Or if the amount is deposited is not utilized for the purchase of the new asset. Okay. Further, there is a lock-in period. Then what is the lock-in period? For the new asset purchased, lock in for new plant and machinery. This is 5 years from the date of acquisition. This is 5 years from the date of the acquisition. Are we clear? So 5 years from the date of the acquisition. And for technology driven startup, for computers and software, this is 3 years. So in case if the equity shares of the company or the new asset is sold within the period of 5 years. So this is lock-in for the new plant and machinery and the shares of the company. In case it is transferred, then the capital gain, which is exempted earlier, shall be deemed to be the income in which either the shares are transferred or the new asset is sold. If shares sold or new plant and machinery sold before the lock-in period, then capital gain exempted would be deemed to be the income in the previous year of transfer. This shall be in addition to the capital gain. This shall be in addition to the capital gain. This shall be in addition to the capital gain on sale of shares or the new plant and machinery. Fine? Yes or no? Okay. Fine. And this is applicable only for the property which is transferred up till 31st March 17. This is only for the properties which are transferred. So you can write it over here up to 31st March 2007. Clear? This is only for those properties. Finally, last one for the startups, there is the loss carry forward under section 79. So section 79 requires all shareholders to remain the same, all shareholders to remain the same in the previous year in which loss is incurred and in the year of set off of loss. Yes, this is also applicable only for the eligible startup. And finally, you have section 80 IAs, okay, which is 100% of profits are deduction is available. Fine, students. So this is I have just summarized for the startup. This 54 GB also it's not very prevalent because this is only for the property which was transferred before 31st March 17. So I've just given a summary of that, but it's all right. You can just remember because this is just I've created the linkage. This is only for the property which is transferred before 31st March 17. So 54 GB is just one provision which was applicable up to 31st March 17 if the property was transferred. Okay. Yes, let's take a break then of 10 minutes and then we get back. Let's take a break. So let's proceed further. Again, going back to my deductions topic, chapter 6A, this was just a summary that I created for the startups. The last deduction that we have to deal with is section 10AA. Deduction under section 10AA. Now, with respect to the deduction under section 10AA, okay, before moving further with respect to 10AA, one important point that I would want to cover with respect to the chapter 6A deduction in relation to the profits. Understand one thing. Let's say, for example, if some disallowance is made, in respect of the profit calculation. Let's say maybe depreciation is disallowed, or let's say TDS is not deducted on an expenditure. So there is expenditure disallowance to the extent of 30% under 40A1A, or related party payment is made under 40A2. Or let's say, for example, the cash payment is made more than 10,000, or the payment is made after the due date of filing return of income under 43B, there is disallowance. Then a question arises that whether when the profits will increase. So let's say, for example, the PGBP is, let's say, 100. Let's say disallowance under section 43B, 40A1A is, let's say, 30. So whether the deduction under section ICAI, IB and all these sections would be 100 or will be 130. So what will be the deduction here? Whether it will be 100 or whether it will be 130. That is the question. So the CBDT has clarified in line with the judicial rulings that the deduction under section 80IB, the deduction under 80IB, 80IA, all of these sections would be 130 and not 100. So you can just write down over here. CBDT has clarified that the disallowances made under section 32, 40A1A, 40A3 or 43B, against which results in enhancement of profits of eligible business, which results in enhancement of the profits of the eligible business, the deduction shall be available. Deduction under chapter 6A, the deduction under chapter 6A shall be admissible on the profits enhanced due to, or the deduction shall be available on the enhanced profits after disallowances. On the enhanced profits after the disallowances. That is one particular point. Fine. The next important point with respect to ATIA, ATIB and all of these sections is, there is one important question which arises. So let's say, for example, there is the loss which is there. There is a loss which is there in respect of, let's say, the eligible business. There is a loss which is there in respect of the eligible business. So let's say, for example, there is an eligible business loss. Now, whether this eligible business loss can be adjusted against the income of the any other business. So let's say there is an unabsorbed depreciation which is there. Let's say there is an unabsorbed depreciation which has been there. Now, can you set off that unabsorbed depreciation against the non-eligible business? So with that in connection, there is a ruling which says that yes, you can set off the losses from the eligible business against the non-eligible business for the reason that, and then you will not be able to claim any ATIA deductions because the income is nil. Are we getting that point? So when basically what I'm trying to do is, there is an unabsorbed depreciation of a business of, let's say, the eligible business under ATIA. Can I set it off against the income from non-eligible business? So the Karnataka High Court in Swarnagiri wire insulations case had held that if you look at section 80IA, that is a specific section. That is a specific section for the deductions for the eligible business. Are we getting that? So that is a specific section which provides for the deduction for the eligible business. And one of the section therein provides that the profit and gains of the eligible business for the purpose of determining the quantum of deduction, for the purpose of determining the quantum of deduction, for the purpose of computing the deduction, the profits and gains of the eligible business shall be computed as if the eligible business was the only source of income of the assessee. There is one provision under ATIA which says that for the purpose of computing the deduction, it will be considered as if the eligible business is the only source of income. So the revenues argument was that if that be the case, ATIA specifically is saying that for the purpose of computing the deduction, it shall be considered that as if the eligible business is the only source of income. Be very, very attentive over here. So therefore, I cannot set off the loss of the eligible business against the non-eligible business. That is what the revenues argument was. So revenues argument was that the unabsorbed depreciation business loss can be set off under section 70. And section 80IA subsection 5 is a notwithstanding clause. It overrides every other clause, which says for the purpose of computing the deduction, assume that the eligible business is the only source of income. So therefore, in that situation, if I say that the eligible business is the only source of income, there is a deeming fiction which gets created. So therefore, ATIA will override section 70, which provides for the set off of the losses under the same head of income. So therefore, I cannot be allowed the set off of the losses of the eligible business against the any other business income. Against the any other business income. So whether I can or I cannot claim. That was the question before before the Karnataka High Court. So what should we do in that situation? So in this situation, the Karnataka High Court answered that the deeming provision which is there under 80 IA 5 cannot override Section 70. The assessee has incurred the loss in the eligible business after claiming the depreciation. Therefore, there is no profit only which is remaining. So 80 IA will become inapplicable. If 80 IA is inapplicable, Section 70 will come into picture, whereby the assessee is entitled to set off the losses from the one source against the another source under the same head of income. And therefore, the assessee is entitled to set off of the loss of the eligible business against the profits of the non-eligible business. Because 80 IA will come into play when there is a profit. There is no profit over here. There is no profit over here. If there is no profit over here, I cannot claim 80 IA, isn't it? So therefore, the set-off of the loss will be available from the eligible business against the non-eligible business. So just write it over here. The losses of the eligible business can be set off against the non-eligible business income under Section 70 intra-head set-off of loss. Since there is no profit from eligible business, Section 80 IA is not applicable, and therefore losses can be set off under Section 7. Losses can be set off under Section 7. Okay? Fine? Yes or no? Okay? Now the next particular point which arises is, can the losses from the non-eligible business be claimed against the eligible business before you claim the set-off, before you claim the deduction? So this is from the eligible to the non-eligible. Now what about non-eligible to the eligible? Now in this case, understand the importance of this particular question. If there is a non-eligible business, now in respect of the eligible business, the question arises whether I claim loss set off first or Section 80 IA first. So whether you claim the deduction first or whether you claim the loss set off first. That is the question which arises. So for that, the Supreme Court in Reliance Energy Limited case In Reliance Energy Limited case, Pay the emphasis on Section 80IA and Section 80A. Section 80A and Section 80IA. 80A is basically your Chapter 6A deductions which are to be claimed against the total income. So let's understand with this example. Let's say my profits from the eligible business is rupees 90 lakhs. Let's say my profit from the eligible business is rupees 90 lakhs. Let's say my loss from non-eligible business is rupees 20 lakhs. Then let's say my income from other sources is 70 lakhs. Sorry, not 70, 15 lakhs. Now the question which arises that the ATIA deduction will be, the ATIA deduction will be 70 lakh or in this case will be 85 lakh or it shall be 90 lakh. Yes, my question to you is, yes, what shall be the deduction over here? Whether 70, 85 or 90 lakhs, what shall be my deduction? Yes, students, faster. Yamini, in that case, the second year will be gone. If it is a 10th consecutive year, if the first year is profit, second year is loss, then second year you have not claimed deduction, it's gone. Then you have to claim the profit of the deduction, deduction for the profit of the third year directly. So you have to consider the 10 years, including the profits and losses. Yes, students, faster. What do you think? 85, Sandhya? Yes. Anybody else think any other answer? Mohammed 70 lakhs, okay. Okay, let's try and understand. So section 80 IA5. Section 80 IA5. It provides that section 80 IA5 is providing us that while for the purpose of computing the deduction, under 80 IA, the profits of for the purpose of computing the deduction, the profits of the eligible business, you have to consider as if it is the only source of income. So just write down, it says notwithstanding anything, notwithstanding anything contained in other provisions of the Act, means it overrides all other provisions of the Act. It overrides all other provisions of the Act. It says, for the purposes of determining quantum of the deduction, for the purposes of the quantum of the deduction, the profits of the eligible business, shall be computed, the profits of the eligible business shall be computed as if the eligible business, as if the eligible business was the only source of the income of the assessee, only source of income of the assessee. So basically, what it is trying to say is that when you are computing the deduction under section 80IA, you have to deal that the profit is the profit from the eligible source is the only income of the assessee. You have to deem that it is the only source of income of the assessee, and accordingly you have to consider the profit. Don't look around for any other source. Don't look around for any other source of income. Are we getting that? So, what it says is that you have to deem there is a fiction which is going to get created. The fiction is that the profits of the business is the profits of the eligible business is the only source of income. You have to consider that while computing the deduction. Are we getting that? So, it says notwithstanding anything contained under any provision of the Act. Are we getting that? So, in this case, if you look at section 80, if you look at section 80AB, which says deduction to be allowed from the gross total income, it says where the deduction is to be allowed under chapter 6A, part C, which is for the income category. Then, notwithstanding anything contained in the section, the amount of the income shall alone be deemed to be the amount of income of that nature which is derived or received by the assessee and which is included in the gross total income. Even section 80AB says the same thing. So you can write here section 80AB. It says the income from eligible business shall alone be deemed to be the amount of income of that nature which is derived by the assessee and included in the GTL. However, Section 80A, Section 80A of the Income Tax Act, what it says is, Section 80A says that the deduction shall not exceed the gross total income. Chapter 6A, deduction shall not exceed the gross total income. So therefore, in this case, considering all these three, 80IA5, 80AB and Section 80A, I will be eligible to claim 85 lakhs and not 70 lakhs or 90 lakhs. So even though while computing the total income, my total income will be PGBP minus 20 lakh Section 70 intrahead set off. So this will be 70 lakh, right? But while computing the Chapter 6A deduction, I will assume that the profits of the eligible business are the only source of income, which is 90 lakh. But since the Chapter 6A deduction cannot exceed the gross total income, the Chapter 6A deduction cannot exceed the gross total income, it shall be restricted to the gross total income, which is 85 lakh, which is income from other sources plus the PG. So whatever computation you do, but for the purpose of Chapter 6A deduction, you will consider as if the eligible business is the only business of the assessee. Are we clear? So we will consider 85 lakhs, not 70 lakhs and not 90 lakhs. Yes, of course, let's say for example, if the gross total income was 95 lakhs instead of 85 lakhs. If gross total income was, let's say, 95 lakhs, then I would have considered entire 90 lakhs as the 80IA deduction. Let's say, for example, if my income from other sources is 25 lakhs. So then in that case, I will consider here entire 90 lakhs and not even 85 lakhs. Are we clear about this? Yes or no, student? This is very, very, very important. Yes, all of you with me? So, understood why are we taking the 90 lakhs? So, let me give you an example for this. Let's say, for example, let's say there is eligible business and there is a non-eligible business. Let's say the financial year I am taking here. Let's say 23, 24, 22, 23, 21, 22, 20, 21. Okay. Let's say this is minus 120. This is 20, 60 and 75. And this is 120, 40, 140 and 100. Okay. Now, I'm adding here a few more points. Includes spread subsidy of rupees 10 lakhs. Then the goods were transferred for rupees 20 lakhs from non-eligible business to the eligible business. Fair market value is rupees 25 lakhs. Secondly, profit of eligible business, profit of the eligible business for financial year 23-24 is arrived at after charging is arrived at expenditure of rupees 10 lakh on technical services paid to, or you can write down just 3 lakh technical services, 10 lakh only, technical services paid to R and company on which TDS was not deducted. Fine. So in this case, first of all, my net profit I will consider over here 75. Now here they say it includes the freight subsidy of rupees 10 lakh. It says the freight subsidy of rupees 10 lakh. Now in this context, understand one thing, that whether the freight subsidy, interest subsidy, power subsidy, whether these kind of incomes which are there, which are received from the government, will be eligible for ATIA, ATIB, all of these deductions. Whether freight subsidy, transport subsidy, interest subsidy will be eligible for ATIA or ATIB deduction. So, the Supreme Court, you can write down, you can write over here, Supreme Court in Meghalaya Steels, Supreme Court in Meghalaya Steels Limited case has held that, Supreme Court in Meghalaya Steels Limited case has held that power subsidies, freight subsidies, interest subsidy has a direct nexus, between the profits of the eligible business, and the reimbursement of the cost. So if you look at when we were writing about these profits, what did I tell you? Profits derived from the eligible business. The wording used is profits derived from the eligible business. The term derived is wider than the term attributable to. It doesn't say profit attributable to the eligible business. It says that profits derived from the eligible business. So when I'm talking about the profit derived from the eligible business, the assessee is incurring certain costs. Transport cost, interest cost, power cost, electricity, all of that. And the government is giving the subsidy for those elements of the cost. These costs are nothing but the cost relating to the manufacture or sale of the product. So the subsidies which are granted in order to reimburse those costs in the manufacturing and selling of product. And therefore, these are profits derived from the eligible business because there is a direct nexus between the profits and the reimbursement of these subsidies. So just write it over here. The subsidies are granted to reimburse the cost incurred for manufacturing or selling the products. For manufacturing or selling the products. Therefore, these are revenues derived from eligible business. These are revenue derived from the eligible business and qualifies for deduction under ATI. Fine. But how about a duty drawback? So duty drawbacks are incentives which are granted by the government in accordance with the Customs Act. What is a duty drawback? Duty drawback are basically the incentives which are granted on the custom duty. Now, whether that is eligible profit, whether that is eligible revenue for ATIA. So, Supreme Court in Orchid Pharma case, you have to remember these case laws. Supreme Court in Orchid Pharma case had held that these are the duty drawbacks, which are incentives which are flowing under the custom scheme. These are not the kind of reimbursements to the cost. There is no cost incurred for that. There is no direct nexus with the duty drawbacks. These are not reimbursement for the cost of manufacturing. So cost of manufacturing, if you are debiting to the P&L account and you are getting the equivalent reimbursement for the same. But duty drawback are not the profits derived from the eligible business. And therefore, for the duty drawback, you will not be eligible to claim ATIA. Just write down. This is for the subsidies. If it is for the duty drawbacks, you can write Supreme Court in Orchid Pharma Limited case has held that duty drawbacks are not directly related to the cost of manufacturing. Are not related to the cost of manufacturing These are incentives flowing under the scheme under customs law. Okay. These are not, therefore, these are not profits derived from eligible business and will not qualify for deduction under section 80 IA and will not qualify for deduction under section 80 IA. Fine. So here if you look at it, 75 lakhs is given, which includes a FRED subsidy of rupees 10 lakh. So FRED subsidy of 10 lakh will be qualified for section 80 IA deduction. If let's say for example, instead of FRED subsidy, it would have been duty drawback, then I would have reduced and would have not given 80 IA deduction on the duty drawback. If duty drawback not eligible. Fine. If it is duty drawback, it is not eligible. Okay. Then there is the expenditure which has been paid on the technical fee for which the TDS is not deducted. So disallowance under section 40A1A, which is 10 lakh into 30%, 3 lakh. I will add the disallowance. And as I told you, the CBDT circular provides that on the enhanced profit after disallowance, you will get the 80 IA deduction. Then there is one more adjustment, that the goods were transferred from the non-eligible business to the eligible business at less than the fair market value. So, here if we look at, the goods have been transferred from the non-eligible business to the eligible business at lesser than the fair market value. At lesser than the fair market value. So, in that particular case, we will adopt the fair market value because deliberately the profits have been tried to shift from the non-eligible undertaking to the eligible undertaking. Here you should write it like this. Instead of here 25, you can make this as 25 lakh. Goods were transferred for the 25 lakh, whereas the FMV is 20 lakh. So under 80 IA as well as under section 80A, there is a provision that if there is inter-unit transfer of goods or services from one undertaking which is non-eligible to an eligible undertaking, the fair market value can be adopted by the AO. As well as if it is a specified domestic transaction wherein the value exceeds rupees 20 crores, then the transfer pricing provisions will become applicable. So here I will add the difference in price of goods, 25 lakh minus 20 lakh. So 5 lakh. Are we clear? Yes or no? Clear? So this is how I will add it. Now, as far as the losses are concerned. Now, if you look at it, there is an eligible business loss of 120. Can I set it off against the non-eligible business? Yes, I can do that. And then there is a profit in all these years. So ATIA permits, ATIA permits the set off of losses from one eligible undertaking with the non-eligible undertaking. So ATIA permits the set off of the loss from the non-eligible undertaking with the eligible undertaking. Isn't it? But if you look at this particular clause, just this, if I do not set it off my losses, so then what happens is, if I consider the business as the only source of income, and I have to start from the initial assessment here. So then in that particular case, what will happen? I will have a loss or a profit over here. Yes. So what will you do in this case? Whether you will set it off loss or will you claim the deduction? Yes, faster. Yes, students. Yes, students, faster. What will you do in this particular case? So, understand one thing over here. Yes, 40 lakhs brought forward loss, which is there, Chirag. How you have to do that? So, as I told you, that the Karnataka High Court in Swarnagiri Wire Insulations Private Limited case, in Swarnagiri Private Limited Wire Insulations Private Limited case, it held that the deeming fiction contained under 80 IE will say that you have to treat the source of income, which is the eligible business, as the only source of income. So, ATIA 5 is saying that you have to consider that the profits from the eligible business is the only source of income. So, what did I tell you? That in case of a eligible business loss, it can be set off against the non-eligible business loss. Because ideally, there is no profit which is remaining under that section. For ATIA to be claimed, there has to be some profit, isn't it? Whether there is a profit or not, the answer is no. In first assessment year 2021, there is no profit. So how will you claim ATIA in that case? So you can set off the eligible business profit against the non-eligible business. But let's take an example over here. for the time being, let's say there is X Limited and it has two units, N and Y. Now let's say the unit N is engaged in the eligible business. And let's say it has a profit of rupees 100 lakhs. Right? It has a profit of rupees 100 lakhs. And let's say the Y is non-eligible business. And let's say it has a profit of 70 lakhs. Now, let's say for example, this profit of 100 lakhs which is there is a depreciation, this is before depreciation of rupees 120 lakh. There is depreciation of rupees 120 lakh. Now, how will you compute the ICAI and the loss? Now, in this case, X Limited has incurred the loss in the eligible business. So, there is a loss of rupees 20 lakh, right, on account of claiming 120 lakh as the depreciation. So, therefore, ICAI is not applicable because there is no profit only. So, here I have a net loss of 20 lakh, right? There is no profit only. So, therefore, section 70 will become applicable. Section 71 becomes applicable. If ICAI is not applicable, now I'm going to section 71, whereby the assessee is entitled to set off the losses from one source against the another source under the same head of income. Now, this 20 lakh I can set off against 70 lakh. This 20 lakh I can set off the profit against the non-eligible business of 70 lakh. And therefore, my gross total income would be rupees. My gross total income would be 50 lakh. However, now remember one point. Once set off is allowed under section 71 against income from any other source under the same head, the deduction of that loss is not possible in the subsequent assessment year. That is, the loss which is arising in the eligible business, which is set off under section 70, has to be first deducted while computing the profits eligible for deduction under section 80IA in the subsequent year, and accordingly the deduction will be computed under 80IA for that year. Now we didn't understand. Let me make it simple for you. Till now you have understood that the GTI is rupees 50 lakh. This is clear. So means I can set off the profits of the non-eligible business of the eligible business against the non-eligible business. But whereas the profits from the eligible business can also be set off against the non-eligible business, the profits of non-eligible can be set off against the eligible. But when I'm talking about non-eligible loss to be set off against the eligible, there is an embargo, which is section 80IA has to be treated as the only source of income. The section 80IA eligible business has to be treated as only source of income. And therefore, when you compute the loss, you have to ignore that loss for the purpose of computing the deduction. The reverse of that is also true. So when in this example, I have a loss of 120. You are saying this 120 which is there. Now, I will start the deduction from which year? It has to be 10 assessment years out of the 15 years. So will I start from 21-22 or will I start from 2020? It is not given in the question as to when the assessee wants to start. But where it is assumed, let's say 2021 is the initial assessment year. Then 70 and 80 IA5, both provisions are applicable. Now, as per section 71, the assessee is entitled to set off this loss with this. Right? So loss from one source can be set off against the another source under the same head of income. So 120 from eligible can be set off against non-eligible. So in the year 2021, my gross total income is 0. Right? However, in respect of, you can write it over here, once set off of loss is allowed under section 71 against any other source, deduction under section 80 IA is not possible in the subsequent assessment year. That is the loss, of eligible business set off under section 71 has to be first deducted, while computing deduction under section 80 IA in subsequent years. So meaning once I have set off the loss, I cannot again take the benefit of 80 IA for the same loss. So once I have set off the loss, what I said is you have to consider that this is the only source of income. So this will not be allowed as deduction. 120 out of this 100 remains. This will also not be allowed as deduction. So now 40 remains out of 120. Now 40 which is remaining as a loss. The deduction this year will be less deduction under section 80 IA. This year will be the profit, which is how much? 75 plus 3 plus 5. 83 minus 40 lakhs. 83 minus 40 lakh, which will be 43 lakhs. So this year, the deduction under section 80 IA will be 43 lakhs and not the entire profits of the 80 lakh. So here, there will be the notional loss of rupees 40 lakhs of the year 2021. This is my notional loss. Are we clear? This is the notional loss which I have to deduct. Okay? Are we clear? Yes or no? So deduction under section 80 IA will be 43 lakh and not 83 lakh. Yes or no, students? Are we clear about this? Yes, students? Are you clear? So you have to consider this as the only source of income in both the situations. Is this clear? So let's say if I'm repeating once again for all of you. Let's say, for example, we are talking about the eligible business and there is a loss from non-eligible business, which was this scenario. There was a profit from eligible business, loss from non-eligible business. You set it off. You do section 70. But for the purpose of ATIA, what will be the deduction? The deduction will be as if the profit is the only source of income. The profit from the eligible business is the only source of income, which is 90 lakh. So entire 90 lakh will be allowed as deduction. But the deduction is restricted to gross total income. I cannot get deduction more than that. So even when you are setting off the loss, you will get the deduction with as if the profit from the eligible business is the only source of. When you are talking about the eligible business loss, setting off against the non-eligible business, you can do that. There is no embargo. There is no profit. There is no question of claiming ATI. So you claim the loss. Section 70 against the non-eligible business. But in the next year, when you will start claiming ATIA, in that year onwards, you will have to first calculate the notional loss as if this was the only source of income. Are we getting that? And the balance deduction will be available to you. Yes or no, students? Quickly tell me, are you clear with this? Yes? All of you, yes or no? I'm not getting any response. This is quite tricky, but this is very, very, very important. Last point, you have to write it down over here. You will write over here. Section 80, or you can write down chapter 6A. You can write it over here. As per section 80A, as per section 80A, where any goods or services, are transferred from eligible business to any other business, are transferred from eligible business to non-eligible business, or vice versa, where the transfer price does not correspond to fair market value, then fair market value shall be considered. Then the fair market value shall be considered for computing the profits. For computing the profits of eligible. This is also provided in section 80IA, 80IB, and all these other sections. Fine. If the value of transaction is greater than equal to rupees 20 crore, then it will be specified domestic transaction wherein the transfer pricing will become applicable. the transfer pricing will become applicable in that situation. Yes, are we clear, students? Okay, yes or no, faster. Fine. Okay. So now what we are left with is section 10AA. Section 10AA. Now under section 10AA, which is there, that is again very much alike to the ATIA and ATIB, all of these provisions. It is very much similar, but that we shall reserve it for the next class because it will require at least 15-20 minutes to explain. And then finally we are left with one small deduction, which is ATTTA, ATTTB. Now you will ask, ma'am, what about the deduction under ATP and ATPA? So ATP and ATPA we are not doing at the moment. We are going to do along with the assessment of various entities in the next class only, when we are going to discuss the cooperative societies together. Secondly, ATM we have already done while we were doing the income from other sources. So I'll just give a quick recap. And then there is one small deduction, which is ATJJAA. And the last deduction that I want to do it for today is ATLA. Now, ATLA is again a profit linked deduction which is given. So you can just write down over here ATLA, which is given to the IFSC units. So, section ATLA. This is eligible assessee here is banks, the offshore banking unit, the offshore banking unit in SEZ, sorry, and banks incorporated outside India, basically having the offshore banking unit in SEZ and unit in IFS. Here, the entire income, which is from the offshore banking unit, which are located in SEZ or unit in IFSC, or income arising from transfer of aircraft or ship, or helicopter leased by unit in IFSC. Okay, where they have commenced the operation on or before 31st March 2024. Then, what is the deduction which is available for the offshore banking unit? For the offshore banking unit, it is 100% of income for first 5 years, and then 50% for the next 5 years. Sorry, 100% for first 10 years. It's not 50%, it's 100% for first 10 assessment year. So earlier it was 50% for the next 5 years, but now it has been 100% only for the 10 years period. And for the unit in IFSC, it is 100% for 10 out of 15 A1s. For the IFSC unit, it has to be 10 out of 15 A1s. Clear? Yes or no? Are we clear? Yes or no, students? Okay. Then the next deduction that we have to do today is you can write down 80 QQB and 80 RRB. These are another two small deductions which I would just like to finish it off before we, close the session today. Because these are very small deductions, no point keeping pending. So 80 QQB and 80 RRB. Now 80 QQB which is there is basically for the royalty income. Royalty income which is earned on by the authors of the books. So just write down the eligible income is the royalties on copyright of books. Royalties on the copyright of the book, except for the journals and the magazines or newspapers. Journals, magazine, or so it should be an actual book basically, and not these journals or newspapers or any guides like that. Okay. Now, what is the quantum of deduction over here? So, the quantum of deduction is is 3 lakh rupees is the maximum deduction or the amount derived from the royalties. Okay. So, lower of income from royalties, the income from royalties or rupees 3 lakh, whichever is less. So basically here you will get the 3 lakh rupees or the income from the royalty whichever is less. And also this is only available to a resident individual. So just write down only to the resident individual. Okay. Yes or no, students? So this is the income before allowing the expenses. Okay. Income from the royalties without expenses. Then 80 RRB which is there. So one more thing, under the 80 QQB, the assessee should bring the income in the convertible foreign exchange within the period of 6 months from the end of the previous year in which he has earned the income. Okay. So here the royalties which are there, which are earned from outside India, then in that case, he should bring the income within 6 months from the end of the previous year in which the income is earned. Where the royalties earned outside India, the income shall be repatriated within 6 months. Income shall be repatriated within 6 months from the end of the previous year in which income is earned. Fine. Now 80 RRB which is there. Again, this is also applicable to a resident individual, but this is in respect of the patents for the invention under patents. So royalties on patents. Okay, for the use of the patents. Royalties for use of patents that they have obtained. Here also the 6 months condition will be there in case the income is earned outside India. That is why I've written it together. What is the quantum of deduction? Here the quantum of deduction is income or the rupees 3 lakh, whichever is less. So same, lower of royalties or rupees 3 lakhs. Here also it will be the same. Yes or no? Fine. Now all of these deductions under ATIA, ATIB, this 82QB, ATRRB would be available only when you are not exercising the optional tax regime. 80QQB, 80RRB is only available to individuals. So only if you opt out on a 115 BAC, it will be available. Viraj, only to ROR, not to RNOR. RNOR is not a resident. Sorry, yes, ROR, RNOR both. Sorry. Yes, it will be available to both ROR, RNOR both, 80QQB, 80RRB. Yes, students. Fine. So with this, we'll stop here for today. I urge you to revise ATIA, ATIB very thoroughly because 10AA also is very, very important. So we will cover 10AA in the next class in detail. So next class, we will finish it off in the first half only, the 10AA, ATTTA and ATTTB. And then we'll of course start with the assessment of the various entities. So ATTTA, ATTTB will not take that much time. But yes, 10AA will take at least 20-25 minutes of ours to discuss because there are certain case laws that also we will have to discuss. Okay. ATIAC, yes, till the date of incorporation for ATIAC, yes. It is from the date of the incorporation, you have to take ATIAC. Yes, Viraj. Fine, students. Okay. Any questions, any doubt before we close the session? Yes. Okay. So thank you so much. See you in the next class. Please revise it. We can close the session.